IPOs, or initial public offerings, seem like all the rage now. Airbnb, Uber, Beyond Meat, and other relatively new companies are just making their debut on the New York Stock Exchange. Some investors have made millions in a matter of minutes when properly trading an IPO, but is that possible for an average investor? Flashy TV headlines and news stories might leave you wondering if you should pick up some shares of the next new company to hit the stock exchange, but would buying a stock like this fit your investing style? Does the return outweigh the risk, or would you be making a gamble investing in an unproven stock? If you enjoy content about money and personal finance, be sure to like the video and subscribe to the channel. You may have heard the term IPO, but what exactly does it mean? An initial public offering is when a private company offers shares to the public for the first time to raise funds for company expansion. When a company is looking for money, they have two main options. They can either take out loans or sell stocks. If owners want to maintain control of the company and restrict ownership, loans are usually a better option. However, new companies often don't have the credit needed to take out the loans they're looking for, which is one reason they may choose to go public. Also, even though selling shares will dilute the ownership, there are no liabilities that will restrict the future cash flow. Expanding companies that are seeking capital usually offer shares to raise money to expand their business, invest in new talent and equipment, make acquisitions, and grow the company. Rest assured, a company IPO that you're considering buying must meet certain criteria, including predictable earnings growth, excess cash to fund the process, and there must be more room for growth within the sector. The companies usually have a strong management team and are one of the top players in the industry. The problem most investors see with initial public offerings is the lack of a track record the company has on the stock exchange, leaving investors taking on more risk. When the company goes public, there's often a lot of emotion involved, with many trades happening very quickly, and sometimes without proper fundamental backing. There's often a rush to purchase an IPO, and emotions can run high among novice and serious investors alike. The fanfare can cloud logic and make purchases appear to be home runs when they are foul outs. Older, more established stocks have already stabilized, which will provide a more stable stock purchase with less volatility. A large percentage of companies aren't even profitable when they go public, meaning they aren't even making a profit on a yearly basis. These investments could be profitable for risk-tolerant investors who analyze the company's fundamentals in depth beforehand. Investors who analyze the company and future prospects obviously have a much better chance at making a profitable purchase. However, Professor Ritter of the University of Florida found during a 23-year study that investors who bought IPOs and held them for 3 years ended up failing to match the overall market's returns. If a company is about to go public that you think is going to do well in the coming years, there are a few things you should be able to answer. How will this help you achieve your investment goals? A stock that you expect to shoot up on the first trading day might increase your returns, but it's important that you weigh the risk and return. How would this align with your overall investing strategy? If you typically invest in a diversified selection of index funds and ETFs, buying an IPO doesn't really align with your strategy, unless of course you are looking to add some risk and excitement into the mix. What does the company do to make money? What are its main products or services? You should make sure that the company has something proprietary about what it's offering, and it's likely that they will continue to make money in the future without major disruption. Are there any foreseeable risks associated with the business? Trade wars or tightened regulations could be a couple of factors that many companies need to look out for. For example, a marijuana company wouldn't benefit from tightened marijuana regulations, but legalization could be good news. There's no question that the excitement and build-up of an initial public offering can be hard for many to pass up. If you don't want to sit on the sidelines watching people joining in on the excitement, and you prefer not to do extensive research and analysis on every company you're considering purchasing, consider investing in an IPO ETF. The ETF will give you exposure to the most significant newly public US-listed companies. The ETF with the ticker symbol IPO buys and holds new IPOs for 2 years, allowing you to participate in any gains and losses the new stocks will experience. As with any ETF and index fund, Diversifying in many different companies could lower your risk while only charging you a 0.6% expense ratio. While there is often money to be made during an IPO, and many investors have made a quick buck trading the volatility and excitement, people who prefer to invest with more certainty and stability usually stick with larger companies. Established blue-chip companies and businesses that consistently turn a profit tend to be better investments over the long term, with much more predictable growth. But there are also opportunities with IPOs as well. Investigating the fundamentals, keeping emotions in check, and exercising due diligence when analyzing your purchase will help you make an educated investment decision.